Welcome to our session today. My name's Andrew Clements. For those of you who haven't met me before, I'm the current chair of Employee Ownership Australia, and very privileged to be chairing today on a topic that is very close to the hearts of all of those in EOA. Before I start, I'd like to acknowledge that I'm speaking to you on the lands of First Nation people all around Australia, and wish to acknowledge them as our traditional owners, and also pay respects to their elders past, present, and to the communities who may be represented here today. If I could perhaps just make a couple of early observations about EOA for those of you who might be unfamiliar with what we do. We are a representative group. We're an employee or member-owned, member-operated, not-for-profit, and our principal goal is to enhance and improve employee ownership in Australia. We've taken a significant and strategic role in terms of recent reforms, and very pleased to have been involved and seen last week's budget announcements on the improvements to particularly the corporate regulation of employee ownership, which it's really encouraging. But that's not what we're here to talk about today. We've got Graeme Nuttall. Hi, Graeme. On the line. Look, it's just a great privilege to have Graeme speak to you today. And for those of you who don't know Graeme, he is the sort of doyen, and he wouldn't say this himself, but doyen of employee ownership in the UK, partner at Field Fisher, qualified as both a lawyer and as an accountant, and has been responsible for the overnight success of EOTs. He did joke with me before that this overnight success came from 2 years of hard work and then just the random emergence of EOTs, which is completely incorrect because there's been a lot of work and a lot of recommendations. For those of you who over the years have had a look at policy settings in this country, inevitably there are innumerable references to Graeme's report on sharing success, the Nuttall Review of Employee Ownership. For those of you who haven't read it, not to embarrass Graeme, but it's a really cool document. And the observations in there, I think, are just as relevant for Australia as they were in the UK. The really telling part of this is, I think, Graeme, there were 28 recommendations in your report, all of which were accepted or partially supported by government, which is in itself a fantastic response. From that, we've had the overnight success of EOTs. But more seriously, if you look at the growth over the last 10 years in the UK market and the role of EOTs, it's been spectacular. I guess as an observation for my own part, before I had the benefit of working with Graeme in relation to EOTs, it would be fair to say I didn't get it. And it was a light bulb moment for me having the benefit of talking to Graeme. So I'm hoping that you all get that light bulb moment today. Just perhaps a few housekeeping moments. We will have Q&A and some good time for Q&A at the end of the session. So please feel free to include some questions. Firstly. Secondly, we are recording today's session, so it should be on it, or will be available on our website later. But more importantly, I'll hand over to Graeme to speak, and look forward to hearing what you're saying.
Thank you, Andrew. Thanks for that kind introduction. And thank you for this opportunity to talk about employee ownership trusts, or EOTs. As Andrew has explained, in the UK, the EOT has propelled employee ownership into the mainstream. The UK has a 100-year history of employee trust ownership of companies, notably because of the John Lewis partnership. JLP operates a well-known chain of department stores and a chain of supermarkets called Waitrose and Partners. But since the recognition of the trust model in the Finance Act 2014, the number of UK employee-owned companies has increased significantly, from around 150 companies, generous interpretation, in 2012, to easily well over 750 companies. And this growth is not just about larger companies like John Lewis Partnership, it is small to medium-sized enterprises moving to employee ownership in their hundreds that has grown the UK employee ownership sector. And almost all these new employee-owned companies have chosen the EOT model. They are majority or 100% owned by an employee ownership trust. And what I aim to do in this brief session is to explain how and why the EOT has been so successful, in particular from the point of view of employees and owners, and indeed advisors, and then discuss the potential for the EOT in Australia. Now, there are already employee owners because of the EOT business model in Australia. This is because of UK employee trust-owned businesses such as Arup that have Australian subsidiaries or branches, and also there is the very first Australian headquartered EOT trustee at Meld Studios, and I believe the EOT will soon become accepted as a way of creating employee ownership of Australian companies as an option to consider alongside worker cooperatives and ESOPs. This has happened in America, but the question is, will EOTs become the dominant form of employee ownership in Australia as it has in the UK? The UK tax law has contained a definition of an employee ownership trust since 2014, but the EOT is a tried and tested successful business model. It is a concept that exists and can work without specific tax legislation to support it. This is why America has readily accepted the EOT as an addition to its range of employee ownership models. There has been no need to change any regulations to establish American EOTs. It helps, of course, if a country, as with Australia, has trust law, but even countries without trust law are currently looking at creating local equivalents to the employee ownership trust. In simple terms, an EOT involves trustee holding a significant shareholding in a trading company on behalf of all the current and future employees of that trading company. Now, Australian businesses and advisors know, of course, about using employee trusts to support employee share and share option plans. The purpose of this type of employee trust is to deliver awards of shares to plan participants, mainly as a financial incentive. Typically, the total percentage of shares allocated to these plans is an insignificant minority percentage of a company's total shareholding. This is employee share ownership as most practitioners know it. And I'm a keen supporter and advocate for employee share ownership, having helped to design the UK's tax advantage enterprise management incentive arrangement, and also helped develop its tax advantaged share incentive plan, or SIP. But sometimes something else is needed. Now, I will from time to time in this talk refer to clients. What would a typical client ask? What would they not ask? Now, I have had a client ask, is there an alternative to direct employee share ownership? Because it has not worked for us. Share prices go up and down. It seems to be good fortune or bad luck as to whether somebody makes money or fails to make money from our share plan. Some are lucky enough to buy low, others have the misfortune to buy high. My answer to that particular client was, have you considered collective employee ownership? Have you considered the employee ownership trust? That conversation led to the very first American EOT. It's important to realize EOTs have a different approach. There are no individual allocations or awards of shares. Instead, shares are held collectively on behalf of all employees of a company as a discretionary class of potential beneficiaries of the EOT. A new joiner automatically becomes a member of that class of beneficiaries and without paying anything. A leaver stops belonging to that class of beneficiaries because they're no longer an employee. This simplifies employee ownership and also simplifies conversions to employee ownership. The UK experience is that it is difficult to convert companies to employee ownership using direct employee share ownership. The share incentive plan that I mentioned, the SIP, is the UK equivalent of the US ESOP. I drafted an Act of Parliament that provided tax reliefs when a SIP acquired more than 10% of a company, and extended the period for awarding shares out to employees. This change to the SIP legislation failed to inspire the growth of employee-owned companies. The EOT, however, has achieved this. I should explain there's some flexibility when I talk about all employee ownership. Participation could be subject to a qualifying period of employment of, say, up to 12 months, and former employees could benefit for a while so as to receive, for example, cash bonuses relating to the financial year in which they were employed. But essentially, an EOT is about benefiting all employees, not just a select few. And it's at this point, I was going to say a eureka moment rather than a light bulb moment, Andrew. I hope you're having a eureka moment. Crikey, you will be saying. Is that Australian? Crikey, you'll be saying. That's a different way of approaching employee ownership. Instead of all the complications and the tax implications and paperwork of employees buying and selling shares, the shares remain owned indefinitely, collectively, on behalf of all employees. However, I expect some of you, the light bulb won't be on, and you'll be thinking, what's the point? Where's the benefit to employees if they can't sell any shares? Well, yeah, let me take you from the eureka moment of Archimedes jumping from his bath to the naked in, naked out approach of partners joining and leaving a partnership. This is the typical model among English law firm partnerships. The naked in, naked out rule means however much the partnership has grown, when a partner leaves, they get back only the working capital they put in. I'm a partner at Field Fisher. 30 years ago, when I became a partner, there were fewer than 40 partners. We had one London office. I contributed an amount as working capital. When I eventually stopped being a partner, that is all I will get back. Notwithstanding, my firm is now an international law firm with a turnover approaching 300 million and 1,700 people across 26 offices in 11 countries. My firm has existed since the time of Queen Victoria. This naked in, naked out approach has helped sustain its longevity, but without compromising on growth and on development. There's no need to value the business and somehow find the funds to buy out a partner when they leave based on the increase in the equity value. Partners in firms like mine are well rewarded year on year from profits distributions. Now, what's wrong with all employees benefiting from a similar approach? Lock up the equity in your company and concentrate on annual profit sharing. The Employee Ownership Trust delivers this type of benefit to all employees. EOT trustee can say, we don't want to receive a dividend on our shareholding. Instead, we want to see the money applied for the benefit of our beneficiaries. This means employees, in addition to market rates of pay and perhaps individual performance bonuses, can receive an all-employee profit share. This is what happens at the John Lewis Partnership, with its over 80,000 employees. Its employees receive a percentage of their earnings as an annual bonus based on the previous year's financial performance. This is a reward to every employee for being an employee owner, in contrast to discretionary bonuses paid by other employers. The employee trust structure means employee profit sharing is part and parcel of how an EOT-owned company operates. Instead of paying according to levels of earnings, the bonus could be based on hours worked or length of service, some other democratic same terms method. It could be the same amount to every member of staff, but typically paying a percentage of earnings works well. The John Lewis Partnership has been employee trust owned since the 1920s. This is a tried and tested model of employee ownership. The benefit to employees, though, is not just financial. Indeed, in some employee-led social enterprises, there are no regular bonuses. Employee-owned companies also provide good work and, in particular, employee engagement, individually and for employees as a group. Employees benefit from improved well-being, from enjoying their work, from training and development to achieve their potential. Many employee-owned companies feature regularly in Great Places to Work surveys. And in this era of technological change, it is vital employers take principles of good work into account to prevent, for example, unfair burdens being placed on employees by algorithms. I should declare I am a trustee of a charity, the Institute for the Future of Work, which has published a Good Work Charter. It sets out wide-ranging principles such as dignity, autonomy, and well-being to encourage commitment and thinking around these principles, especially in response to technological change. And evidence shows that where there is good work, people are healthier, for example. And so providing good work is in an employer's interest. A business can use this charter as a checklist to make sure it provides good work. It could adopt the Good Work Charter or an equivalent commitment. The John Lewis Partnership Constitution promises worthwhile and satisfying employment. And it is employee engagement in particular that is key to accessing the benefits of employee ownership. The aim is to benefit from employee voice both individually and for employees as a whole. This means every employee can speak up and be confident they can be heard individually and as a workforce. So this is not just because someone is a gregarious individual who gets on well with their manager. They're listened to because this is company culture. And obviously an example where this dialogue is crucial currently is in relation to hybrid working and flexible working. A decision on splitting home and office working or adopting flexible working hours is not one to be taken by managers in isolation from what employees have to contribute. Now, there are well-known simple ideas that can help generate better employee engagement, sharing more information, including financial information, explaining that information, staff suggestion schemes, and consulting more widely before implementing change. This can all be done relatively informally. Employee voice can also be formalized by building it into a company's governance arrangements. There can be a staff council representing staff. There can be employee selected or elected representatives attending board meetings, or indeed as members of a trading company board. And these are all typical features of UK employee-owned companies. Now, companies without employee ownership can have very good employee engagement. But the difference between employee-owned companies and other companies was brought home by another client question. A client explained, I've got great satisfaction results. I listen to my employees, and if they want a new bit of technology to do their job better, I buy it. But I am worried. One day they will realize that I am the one who benefits from all the extra profits. What can I do to maintain great employee engagement for the long term? And the answer is that employee ownership is a profound enabler of good employee engagement for the long term, especially when combined with profit sharing, in particular by using the employee ownership trust model. So from an employee's point of view, employee ownership works. It provides good work, great employee engagement, and a share in the profits. However, it's unlikely a business owner will approach an accountant or lawyer and say, I'd like you to give me some advice on making my staff happy. What's more likely to happen are questions related to where the company is in its business life cycle and the owner's plan for the future. A question you might more realistically hear is, how may I promote staff based on merit rather than their risk appetite and ability to buy a share in the business? I'm not really interested in a management buyout over time. And more directly, a baby rhythm client may say, look, I'm looking to step back. I'm looking for a business succession solution. I don't want to sell my company to a lifelong competitor. What else do you suggest? And it is business succession is the predominant source of new UK employee-owned companies, and that EOT is the best way of managing this change. This is the combination of circumstances that makes the EOT such a success in the UK. The EOT meets the demand, and it meets it well. Any private company owner considering a move to employee ownership will immediately appreciate the advantages this offers compared to, say, a trade sale. It avoids sharing trade secrets with competitors and gives control over timing. But if we explore motives more closely, we find specific aims among those choosing employee ownership as an exit solution regarding legacy, preserving a company's independence and ethos, achieving the right sort of stable, long-term new ownership for a company. These are all aims that the EOT can help fulfill, and more so than with direct employee ownership, because these aims can be written into the EOT's constitution. The EOT model allows a company's ethos to be maintained and developed. If a company wants to embrace corporate purpose, that can also be part of how the company's ethos is defined. I explored this idea in my 2020 Gandhi Foundation lecture, for anyone who wants to look at that in more detail. Speaking to corporate partners, I get the response, I'm envious of you, Graeme. My clients, when they sell a company, they hide in embarrassment and they phone me up typically a few months later saying, I wish I hadn't done it. Or the team I built up, they've left. I'm a bit embarrassed. At the extreme, I've heard tales of wives of former company owners avoiding their local supermarket because the new owners made so many people redundant, she daren't shop there anymore. In contrast, I have clients who go to the golf club. I'm just, bear with me for a moment, I couldn't think of a more egalitarian example, and they will share with their friends, hey, I've just done a great thing. My company is successful. The people who helped build it up are enjoying taking it forward, and I'm enjoying the fact that they've still got my name above the door. There is a contrast. There is a difference with the EOT approach to succession planning. And indeed, EOT has clear practical advantages over trying to use direct employee ownership as a succession plan that can be summed up as fewer moving parts. EOT ownership neatly avoids the upfront and ongoing administrative complications and communication issues around individuals buying shares as a succession solution. Moving to employee ownership is easier than a trade sale, with the only parties to the transaction being the sellers, the trading company, the trustee, and perhaps a bank. So let me explain a bit more about the legal structure of an EOT, then move on to how EOT buyouts are financed. But first of all, let's have a refresher summarizing what I've covered so far. We can see that the purpose of an EOT is to provide permanent or long-term employee ownership of a company or the parent company of a group through holding a significant proportion of a company's shares for all employees. Individual employees do not get awards of shares. The trustee holds the shares on a discretionary trust for the benefit of all present and future employees. Trustee has custodianship of the trading company, using its shareholding rights to ensure employees have good work, great employee engagement, and a financial share in the company's success through cash bonuses. And how do we create that as a legal structure? Well, let me explain briefly the legal structure that allows an EOT to hold that significant shareholding on behalf of all the employees of the trading company. It obviously is the UK approach, but I believe that you will readily recognise the component parts of it. The person who establishes the EOT in the UK is usually the employing company, the trading company, but it can be a third party who puts in the nominal initial trust fund to create the trust. And a trust deed sets out the terms of the EOT. In particular, this document will make it clear how the beneficiaries are to benefit from the trustee holding a significant proportion of a company's shares. It will set out that purpose of achieving and sustaining long-term employee ownership. And it usually means holding over 50% of the shares in a company. And unless there's a hybrid model involving an element of minority direct employee share ownership, most companies in the UK will build up to 100% of a company's shares. As I will mention briefly, the UK government provides tax benefits when an EOT acquires and holds a controlling interest in a company. As mentioned, the trustee has custodianship of the trading company, and it uses its shareholding rights to ensure employees benefit financially and non-financially, in particular by maintaining the company as an employee-owned company. And in the UK, the trustee is typically a UK tax resident company, a UK incorporated company established solely for the purpose of acting as a trustee. Such company is simple to administer with minimal regulatory requirements. The trading company typically administers the company itself. That trustee company has no assets of its own. The admin costs are covered by the employer trading company. And this approach also provides limited liability for the trustee directors, and it gives freedom to choose who is on the board of directors of the trustee company, freedom to choose the best body of individuals to deliver on that EOT's purpose. And best practice is a so-called paritarian composition of trustees, meaning there is parity in the number representing management and those representing employees as a whole, with an independent chair, perhaps a professional advisor, or maybe one or more independent directors on that trustee board. And the trustee company meets periodically to check that it is achieving the EOT's purpose, to review the financial performance of the company, and in particular to review what the company is doing to support employee ownership, so as to ensure trading company is a successful, professionally managed, independent enterprise with a employee ownership ethos. Now, trading company itself, as we've heard, the shareholding in EOT provides employees with a voice in the business as a shareholder. Within the trading company, we have to consider employee engagement. And as mentioned, many employee-owned companies provide employees with an employee council, so they may express their views directly to the trading company board, and indeed have members, employee elected or selected members on the trading company board. Employee ownership therefore provides a much broader, richer relationship with a business for an employee than in other business models which rely solely on the employment contract. And I can discuss this more widely, but in my experience, this employee representation accelerates and amplifies main board decision making. Pulling this together, you see an overall structure. This overall structure allows for a variety of ways in which to create employee ownership tailored to a particular company's requirements. I mentioned the flexibility regarding employee voice. There can be minority, direct, or employee share ownership plans running alongside EOT. Senior executives can have separate incentive arrangements, provided these are consistent with the EOT's purpose. In particular, a founder's wishes regarding maintaining the company's ethos and how difficult it is for the trustee to sell the company can be reflected in the trust deed and other governance documents. And sellers need not leave the business immediately. They can stay on the trading company board. They may retain minority shareholdings. Which brings us on to the money. Spoken about an EOT buyout. Let's discuss how that buyout is financed. It's financed by company money, by distributable profits. Basic financing proposition in the UK is that the trading company makes voluntary cash contributions to the EOT to provide the trustee with the funds to buy shares, to pay initial and deferred consideration to the sellers of shares. Now, trustee must pay no more than fair value for those shares, because otherwise it would be in breach of trust. These gifts to the EOT are received tax-free by the EOT trustee, but they're not tax deductible for the trading company. As I say, this is the UK analysis. Contributions must be made from distributable reserves to avoid company law complications. And the sellers realise a capital gain. They're not taxed on the sale proceeds as if they have received dividends. Financing can be used, but this is not typical because often the sellers will self-finance by deferring consideration until the trading company can pay. If 100% of the shares are being bought by the trustee, this can mean deferred consideration periods of up to 10 years. This approach to financing is accepted by sellers. Sellers accept the credit risk of deferred consideration. Probably partly helped by the fact that research shows that employee-owned companies can generate increased profitability, they are resilient, and they can innovate well. And in many cases, this ability to take on deferred consideration is also helped by sellers remaining involved in the business. Where this approach does not work in a particular country because of tax or other regulatory rules, an alternative financing approach is possible, typically using the purchase of their own shares directly by the trading company after the EOT trustee has acquired an initial small shareholding. That initial small shareholding, of course, becomes a significant stake. The company buys in and cancels other shares. We've covered the financing. I come on now to the Finance Act 2014. This is a UK statute. As emphasised, this legislation did not create a new way of moving to employee ownership. Employee trust buyouts happened before 2014. It was one of the successful models of employee ownership that had been tried and tested since the 1920s. That was why I was confident to recommend it to the government in my Nuttall review of employee ownership in 2012. What the Finance Act 2014 did is capture some elements of best practice and codified them, especially the all employee benefit requirement. Again, please understand the Finance Act 2014 is not a complete guide to establishing and operating an employee ownership trust. It captures certain elements. And a EOT, as defined for tax purposes, must benefit all of a company or a group's employees, and any distributions must be on the same terms. As I've mentioned, includes reference to distributions by earnings, hours worked, or length of service. But in practice, the trust does not distribute anything. It's the employing company that pays out cash bonuses. Legislation also contains some anti-avoidance provisions that again reflect best practice, such as prohibiting loans to beneficiaries. An EOT in the UK that meets these requirements benefits from a UK capital gains tax exemption for individuals selling a controlling interest to the trustee, and an income tax exemption on certain employee bonuses once the EOT holds a controlling interest in the relevant company. But I would say, in my experience, it's not tax exemptions that are propelling the growth in employee ownership. Tax efficiency is important, tax fairness. What these tax exemptions have done is act as a fundamental nudge, a major kick in the pants to advisors to remember to talk about employee ownership. One of the reasons why there's been a growth in UK employee ownership is that it is now very difficult for UK professional advisors not to mention an EOT when owners ask about succession solutions. They now have to mention something they might not have done before because it was outside their comfort zone. Also, the EOT legislation has helped point advisors, it has helped educate advisors as to what employee ownership means. And also it presents an official UK government approved means of converting a company to employee ownership, which does add confidence, particularly in the early years after its introduction to owners to adopt this model. In practice, once the EOT is explained to a company, the company owner will say, that's the model I want to adopt. There's no need to look at alternatives. It is worth reflecting on those pre-2014 pioneering experiments. There had been a good number of pioneering experiments when trying to structure employee ownership in private companies. Individual ways of creating employee ownership arising typically from one founder's vision of what they wanted for the future of the company. I've mentioned John Lewis Partnership repeatedly, but there are many others, such as the Scott Barder Commonwealth, which is charity owned, with every employee being a member of that charity. But the point I want to make is that time and time again, it was the employee trust model that proved successful and easy to operate and easy to work. And indeed, a couple of companies that tried other methods based around direct employee share ownership have now converted to the EOT model. Time and time again, the trust model has proved successful. And it's worth emphasizing that companies moving to EOT ownership have previously been owned in a variety of ways, ranging from a listed company through to directly employee-owned companies, as I mentioned, that have switched to EOT ownership. EOT ownership can apply to companies whatever the size and nature of the workforce. John Lewis Partnership has over 80,000 employees. But the EOT model can cope well with smaller numbers. It can cope well with seasonal workers. It can work well with an international workforce. The EOT model is also proven to work whatever the nature of the company's business, whether producing goods or services or both. It is now a mainstream way, for example, of owning businesses such as architects or construction companies. I've explained how the employee ownership and in particular the EOT allows founders to sell out in a structured and measured way so as to preserve their legacy, continuity and independence of the business. I've explained benefits for the selling shareholders and employees. Employees become ultimate owners without needing to raise capital. Employees may be promoted on merit to the trading company board, not based on their willingness to invest in the company, or indeed their ability to invest in the company. The employee ownership model has shown itself to be productive and sustainable so that the deferred consideration gets paid. Pre-pandemic, indeed, it was getting paid ahead of schedule. And I haven't said much from a policy point of view, but you can carry on with the advantages of employee ownership by emphasising the macroeconomic effects, or at least their potential. At scale, employee ownership can reduce inequality. It can make a major impact in local economies. Now, it's at this point, it's at this stage in the meeting with a client that the inevitable question gets asked. What's the downside? All you've told me about are the advantages. What are the disadvantages? And generally speaking, I struggle to mention disadvantages, but I've come up with some. And these concerns fall into three main categories. Model has got to be right for business. In particular, management has to support employee ownership, embracing participative styles of management. If you've got a next generation of managers who are hell-bent on a management buyout, it's going to be difficult to implement and carry forward an employee ownership arrangement if the managers you have lined up as your successor really want a management buyout. They want a stake in the game. Also, employees have to want to work for an employee-owned employer. I've never known that be an obstacle, even in the most trade unionized of companies in the UK. But conceivably, there may be employees who just want to be told what to do in a dictatorial manner and quite like to clock off and complain about the boss in the pub after work. But in my experience, most employees actually like working in an employee-owned company. But the concept, culture may be an obstacle to implementing employee ownership in a particular company. Most businesses converting to EOT ownership already have the right sort of culture. And in effect, what they're looking for is an ownership and governance structure that fits with how the business operates. They want to create an integrity in their ownership structure, bolster existing good employee engagement and profit sharing. Now, there are genuine commercial risks in relation to the deferred consideration concept. The sellers get paid over a period of time, and sellers will need to be patient to receive their deferred consideration. Some elderly shareholders may not want to sell to an EOT. I did have to say to a gentleman in the 80s who said, my wife has told me I really ought to think about succession planning and estate planning. What about an EOT? And I had to say to him, the business was also heavily leveraged already. So I'm sorry. I think you've run out of time to implement an EOT and you really ought to look at a trade sale. So some elderly shareholders may not want to sell EOT. Also, focus during the deferred consideration period will be on paying the sellers. This may restrict investment and detract from employee engagement during that period, but it's only temporary. After a few years, the sellers will be paid off and employees will benefit from fully ownership in business. And I would say that, again, in my experience, I'm chair of several employee trustee companies. Paying off deferred consideration has not hindered the growth of the business and the investment needed to carry that business forward. There are also possible disadvantages from the model itself. The company is locked into a new structure, which is difficult, not impossible to change. EOT controlled businesses may be less attractive to third-party investors if equity investment is required in the future. An EOT is unlikely to be tax effective if an onward sale is likely. If your business is dependent on regular inflows of new equity from outside investors, then probably you should be a listed company and this model is not right for you. But in respect of this category of problems, most owners say these are not problems. This is what I want. I want a structure that is designed to remain independent for the long term and not one that is susceptible to being taken over. I've spoken about the interest from business owners in finding a succession solution and how the EOT provides a practical, flexible and attractive solution. Provided a country has supportive regulatory framework and other building blocks are in place, it seems to me that the EOT or an equivalent using local legal forms can help grow employee ownership. I've explained something about how and why EOTs have taken off in the UK from the point of view of employers, owners, and indeed advisors. This diagram shows the accelerated growth of EOTs up to June last year. When we reproduce this diagram, we will show that growth in EOTs has continued to accelerate this year. The pandemic has not stopped that. Indeed, perhaps the pandemic has forced employee owners to think more about succession solutions and what they want those to look like. A caring, long-term, sustainable method of owning the company that they have built up, and have looked to EOTs as a succession solution perhaps more readily than they did before. I look forward to discussing potential of EOTs in Australia. Hand back to you now, Andrew, to take that discussion forward. Thank you very much.
Oh, thank you, Graeme. Look, it was fantastic. There are quite a number of questions, and I'd encourage everyone, if they have questions. This is a wonderful opportunity to have a true expert pass on knowledge to us. Graeme, there are quite a few questions around what I'll call the transition process, and particularly, and I think you've probably addressed part of this, but a little bit around how the initial capital would go into the EOT, and a little about the tax consequences of deferred payment structures. And I'm conscious that's I mean, there will be unique elements in Australia to that, but I'm just interested in how that deferred tax consideration and how the funding process works in the UK.
Yes, the trustee and the sellers essentially agree the sale price, a fair value, and they also agree a payment schedule. So there's a clear understanding over how long that payment period is expected to be. And the trading company board then meets and agrees that it will support that deferred consideration by making a series of voluntary contributions during the deferred consideration period into the EOT. This is the UK approach. And so each year from distributable profits, the trading company will make a payment into the EOT. And as I mentioned, that is not tax deductible, expressly not tax deductible under UK rules for the trading company, but it is received as a gift. It is received tax-free by the trustee, again under UK rules, long-established rules that predated the Finance Act 2014. That means that periodically the trustee has the money available to it to pay an instalment of deferred consideration to her. And now there is flexibility. I mentioned we have seen payments accelerated if a trading company has an employee ownership boost from employees actually working a lot more productively when they own the company themselves. And we have seen that embarrassingly so on a few occasions. We've also seen occasions during the pandemic when a company has said, we really do need to build up reserves. We're not sure what lies ahead. And so sellers and trustee have agreed to hold off on a deferred consideration payment. What is very helpful in the UK is that all those sale proceeds, both the initial and the deferred consideration, are received tax-free by the seller. And that is because of the tax exemption in the Finance Act 2014 for anyone selling a controlling interest to an EOT. And so in the past, someone may say, I want to try this out by putting 10% of my shares into an EOT and seeing how it works. Well, now we have sellers naturally saying, well, I better sell 50% or over 50%. because I then get a capital gains tax exemption. Before the capital gains tax exemption operated, then there would be an upfront tax charge on the whole consideration, and clearly the initial payment would have to be at least large enough to meet that deferred tax, that upfront tax on the deferred consideration. So I hope that explains that point clearly enough.
Thanks, Graeme. There's also a question, but slightly different approach about a workers' cooperative model rather than an EOT, and what your thoughts are in the comparative benefits.
Yes, when I gave those statistics about moving from 150 employee-owned companies to well over 750, I was excluding worker cooperatives, or at least excluding the typical UK worker cooperative. There are probably about 400 worker cooperatives in the UK, and the typical model is that they have 5 or so employees. They're relatively small organisations, typically self-help organisations. Great supporter of worker cooperatives. They work well, particularly in a startup context, when a small group of individuals want to work together and sign up to the cooperative principles. But there has never been, in all my experience and all my years working in the employee ownership sector, any interest in using any sustained, any material significant interest in using the worker cooperative model as a succession solution. I have come close to reinventing the worker cooperative for some clients pre-2014 by introducing one person, one vote arrangements, but those clients were not interested in signing up to the international cooperative principles. So what I have found is that in conversations with the owners of businesses looking for succession solutions, the worker cooperative model, yes, it gets mentioned, but typically it's put to one side, and it is the EOT model that is the one that is of interest and works in practice. Again, my experience of trying to convert companies to employee ownership by individual employees investing in a company, I found it's very cumbersome. It's difficult to manage, difficult to implement. So worker cooperatives, I think, accepted view in the UK is they have their place as startups, smaller enterprises, 5 or fewer employees, but they have not been part of this growth of employee-owned companies in the UK.
That's great. There's a couple of questions, Graeme, with a similar theme around the relationship and operation of how a charity might be engaged or involved in an EOT, and I guess particularly some of the structural aspects to that. A little bit focused on some of the Australian-centric elements, but I think probably what would be most helpful is to get a sense of the experience you've seen of, if I can call it, charitable engagement or involvement in EOT models in the UK.
Yes, a lot of trading companies have a separate charity which is used for charitable giving and supporting the charitable aims of a company. But if you're looking at charities as shareholders in a business, as owners of a business, then we have had a few experiments with that in the UK. And in particular, ARUP actually divides its ownership between a charity and an employee trust. Scott Varden, as I've mentioned, is wholly owned by a charity. And indeed, there is a surgical blade maker, which again splits its ownership between a charity and an employee trust. The difficulty is that charities have to pursue charitable objects, and the UK Charity Commission is reluctant to accept that a long-term, undiversified, significant valuable shareholding in a trading company is a proper investment for a charity. There is a constant pressure on a charity to diversify its investment, to have a broad-ranging portfolio, to manage its investment risk rather than maintain ownership of shares in a charity, in a trading company for the long term. And that has been overcome in specific cases. So Scott Barter's charitable purpose is to hold itself out as an exemplar of sustainable good governance, a democratic ownership model. And so it argues that its purpose is to hold, shine a light onto this particular business model. In other cases, for example, Swan Wharton, the charity is there to support, relieve poverty among employees, or rather former employees and their dependents. And so there's a particular reason for it existing. And similarly, Arup is there to channel funds into good causes. But, sorry, a long answer, but essentially it's been tried and tested, and I would say it's problematic. You really do, as a trading company, really do need to understand charity law. What you really do need to keep your eye focused on what your charity is doing and how well it is achieving its charitable objects, which is something you don't have to do with an employee ownership trust, which is much more common sense.
Right, so this actually is my question, but I'm really interested in some your observations around how important the, if I can call it, prudential limits that have been introduced through the UK tax rules have been in creating a sort of constant and even structure that people adopt simply and easily, and has perhaps limited some of the potential excesses in where employee ownership trusts might have been used.
It is extremely helpful to have, in effect, a one-size-fits-all approach in the UK. Certainly from a research point of view, if you're looking at an EOT, you know what you're looking at. You know you're looking at majority employee ownership for the benefit of all employees. When the legislation was being drafted, I brought together a group of existing employee-owned companies to meet with HMRC, with the UK Tax Authority. And it was with some trepidation I had held that meeting, because I said, we are going to tighten up the rules. We are going to require employee trusts to look a particular way going forwards. And the employee-owned companies all said, well, this is fine. This is what we do anyway. There's no problem here. That's absolutely fine. And so it works from a practical point of view. It works from a research point of view. And I think it has worked very well to keep everyone's eyes focused on the EOT as a concept. And I have had concerns about perhaps people trying to manipulate the structure, but although you see the occasional reference to it as a theoretical idea in accountancy blogs, actually we've been unable to find any evidence of it. EOTs are by and large keeping to their purpose. The main criticism is during the deferred consideration, they may not actually be engaging with employees as fully as they could do, but that will change once the deferred consideration is paid and the trustee has to focus on employee engagement. I hope that answers your question.
Graeme, I'm conscious that we've taken a lot of your time, and if I could ask you one last question, which came from the audience, was the role of an advisor in assisting the transition into an EOT, and not so much from a legal perspective, but in terms of managing cultural change, and what are your learnings out of that, and where have you seen people do that well in the UK, and what could we learn from it in Australia?
Thank you. Well, as you know, I'm just starting my day, so keep the questions coming if you if you want to. I'm conscious that it's you who want to head off home. It is important that an advisor gets employee ownership. It is very important that an advisor understands what the employee ownership trust is all about. If someone just looks at the Finance Act 2014, they are going to crash and burn in delivering employee ownership. And so I would say the role of the advisor does go beyond the usual technical, legal analysis of what's going on, and that you really do need to be all over the purpose and confirming to your client that these documents, that this process they're going through will deliver employee ownership purpose. Now, lawyers, accountants have their limits. They can't advise and consult on everything. And one area is to do with the people side of things. How do you get the best employee engagement out of your employees, given the context of your business? And I say to company founders, do you need assistance on this? That there are experts who have been doing this, typically in the John Lewis Partnership, former John Lewis Partnership employee owners who are now advisors to help with a cultural change. The experts do exist, but as a general rule, as I say, companies already have this great culture. They already have great employee engagement. They know what needs to be done. And they say to themselves, well, we'll think about that. We'll think about taking external advice, but actually, we think we can manage this ourselves. We know our people, we know our business. We can use this employee ownership model to get these results that we want to enhance employee engagement. We can explain the profit share to our employees, and we can provide good work. So I do find that accountants, lawyers can almost be a one-stop shop for this in terms of delivering the advice to the clients and supporting them to deliver employee ownership, with perhaps an expert share valuer brought in to provide that justification for the market value of the share price.
Graeme, it'll be obvious to everyone who's had the privilege of listening to this, the depth of knowledge and the benefit that we've had working with you. And we're very grateful for your help in developing EOTs in Australia. We, as an organisation, EOA is we're very, very keen to see this structure work as a broad-based ownership structure, and we'll continue to hopefully work with you, but also work with both members, but particularly with government and regulators, and trying to work through some of the aspects to it. I think probably, Graeme, just as an observation for you, be interested just in closing your thoughts on, we've worked together on EOTs for a while, your sense of the Australian regulatory system, and at a scale of 1 to 10, how hard you found it, because we're very good at actually writing off the ability to do anything in Australia. So I'm really interested in a thought on that.
Yes, my experience with Australia and employee ownership almost goes back 10 years. You kindly invited me to talk at an EOA conference a while back, and I had my meetings then with Treasury officials in Australia, with your company department, and I was taken aback by the almost paternalistic approach to legislation you have in some areas in Australia, being worried about risk, particularly that employees might be harmed in some way by being fully engaged in a company or having a share in its success. But what I have learned in the UK is that if you don't ask, you don't get. I did not really expect to get a capital gains tax exemption from the Treasury. I did not expect to get an income tax exemption on all employee bonuses. I had hoped, and I did get support from the government for employee ownership as a great way to run a business. Following the Nuttall Review, we had 2 years of the UK government saying employee ownership is a great thing. We want to see a diversity of ownership models. We want something as an alternative to the listed company. We want to see a particular business model that reduces inequality. So I believe the Australian government can support that. But actually, I was speaking in parallel to Treasury, and eventually HM Treasury saw that this was a powerful tool as well, a powerful economic tool. And so please ask. And if the UK example is to be followed, you may get.
Well, I think, Graeme, you can be assured of one thing: we will continue to ask. Thank you again. Also, thank you to everyone who joined. I know collectively, I don't know how you do this, but this is the moment where you sort of clap and wave hands, but it's a bit hard to clap and wave hands when you can't be seen. So if you can sort of do a virtual clap and wave hands to thank Graeme. We've got a series of webinars that you can access. Please feel free to go to our website and look out for them. But also we'd encourage you to look out for the further webinars that we've got coming up. And look, just in closing, thank you, Graeme, and thank you for the audience.
Thank you, Andrew, and thank you for listening.
No problems. See you all soon.